You really shouldn't have to feel unsure if an annuity helps your retirement income plan or if it hurts it. After watching this video, you won't. Let me tell you why this topic gets so messy for so many investors. I can sit with two retirees in the same exact week. One was told annuities are the safest thing you can own and invest in. The other was told never buy an annuity. Both walk away confused, both feel like they're one decision away from really messing up their retirement. And here's the problem. Most people think annuity is one product, and it isn't. Annuity is a category, and inside that category are multiple types that behave very, very differently. So, in this video, I'm going to give you a simple way to understand what you're actually looking at and how to judge if it actually fits your plan. For those who don't know who I am, my name is Tyler Lavoie. I'm one of the founders and senior wealth advisors here at Guardian Financial. My job is to help retirees turn their hard-earned savings into reliable income. And just a quick note for you guys, this is just educational. Raymond James doesn't provide tax or legal advice, so talk with your tax or legal professional about your situation. And when I use the word guarantee, it is based on claims of the paying ability of the issuing insurance company. So with that being said, let's get started. All right, so at the most basic level, an annuity is a contract with an insurance company. And so there's an owner who controls it, and there's usually the annuitant who is also the owner, but sometimes that is not always the case. There's a beneficiary who receives the assets if anything was to happen. And then the insurance company is the one that backs and promises the contract. That's it. Now, here is where people get tripped up the most. Before you talk about the annuity, you have to talk about the money going inside of it. Because the tax rules come from the source of the money, not just the word annuity. If it's non qualified money, meaning after tax dollars, the growth is tax deferred until you take it out. Gains come out as ordinary income. There are no required minimum distributions. And pulling gains before the age of 59 and a half can trigger a 10% federal penalty. If it is qualified money, however, like IRA dollars, you still have ordinary income taxes on the withdrawals. So those RMD rules still apply. The same under 59 and a half penalty rules can still apply here. So step one is always this. What type of money is being used? Now we can talk about the different annuity types. So there are four main types of deferred annuities that you'll most commonly will run into: fixed, fixed indexed, RELA, variable. And these four buckets are the reasons opinions are really all over the place because people argue about annuities as if they are one thing when they are not. And this is really the simplest way, in my opinion, to try to think about them. All right, so a fixed annuity is like the plainest version of annuity you can get. It has a stated rate, usually for a set term, often in that 3 to 7 year range. Principal protection is part of the design of this vehicle. So it's meant to be steady, not really flashy. Also, what's really important is this is not FDIC insured. So the guarantee is based on the insurance company, not of the government. And like most annuities, it is designed to be long term. So surrender charges can apply if you decide to try to exit early. So a fixed index annuity is where people hear market and automatically assume that their money's invested inside of the market. It is not invested directly in the index. The contract credits interest based on index performance using rules like a cap, a participation rate, or a trigger. So the growth inside of this is linked to an index, but is still a contract with crediting rules. That is why when you have two fixed index annuities, they can feel completely different, even if they happen to mention the same index. So a realist sits in the middle. This investment is linked to an index, but your account value can go down. So the principal is not fully protected in a way that a fixed annuity actually would be. And so these investments often use a buffer or a floor inside of the makeup of it. And a buffer simply means the contract absorbs losses up to a specific point, and then losses beyond that can really hit your account value. And a floor means losses are limited to really just a set amount, but you can still have a decline to that level. And so the reason why people use realists is for some versions of this. They want to have more upside potential than a typical fixed index design might offer, and they're okay and willing to accept some of the downside risks within defined rules of how this investment operates. A variable annuity is the most market linked exposed to the group. So the value is tied to the underlying investment options, and there is no guaranteed principal, and it really moves with the market. And this is where fees, riders, and prospectus language really matter, and it really deserves careful review. Now, here's the part most retirees actually care about: income. Now, there's two common ways annuities are used for lifetime income. One is annuitization or a guaranteed withdrawal rider. And these sound very similar, however, they are not. Annuitization is a clean trade because you exchange a lump sum for an income stream. Immediate means income starts within a year. Deferred income means it starts later. And so this is usually the most straightforward form of income for life. But it is a trade. You're exchanging liquidity now for income. The second method is a guaranteed withdrawal benefit rider. So this is where people get confused the most because there are usually three numbers. First is the account value. That's your actual money inside the contract. The income base, and that's a calculation number used to determine the income and is not a cash value. And finally is the income payment. That's the lifetime withdrawal amount under the rider rules of the annuity. And so this method appeals to people who want a lifetime income feature, but still want to have an account value attached to the contract. And so these riders come in at additional cost. Fees and charges matter because they can impact results, especially for your retirement. So if you're watching this and really thinking, okay, how do I know if this helps or hurts my plan? Here is the filter that I use. One, what is the problem the annuity solving? Is it solving for income? Is it solving for market volatility? Is it solving behavior, meaning that you do better with more structure in your plan? Is it solving a longevity concern that you may have? Then ask the practical questions. How soon do you need this income? How much income do you actually need? How much market exposure or can you actually live with? And how important is liquidity to you? Do you care more about lifetime income or leaving the most behind for your beneficiaries? If a rider's involved, what does it cost and what does it do? Because the goal is not to buy an annuity. The goal is to buy a retirement income plan that you can truly feel confident in. Annuities ultimately are tools, and they're good tools when they fit, bad tools when they are forced.